Welcome to this video. It's Monday. It is the 10th of July, 3:30 p.m. GMT. What we'll be doing today is looking at trading breakouts. I'm going to look at a specific setup which I believe increases the probability of the breakout following through to the upside. Also gives you good risk to reward. And let's face it, most breakouts are fake outs. Now, in terms of the technique I'm going to use today, I've actually taken it from one of the great traders of all time, a guy called Bruce Covenor, interviewed in the book The Market Wizards. And when I first read Market Wizards, I thought, actually, you know what? That is a great way of trading because it really does put the odds on your side. So what I'm going to do now is just going to go to the charts. I'm going to discuss the logic of why this technique works. Then we're going to look at some potential setups in the market. So let's look at the charts. Chart of GBP try. Now, I just want to explain this chart in a moment. It's a trade that worked for us last week. Those of you who watched our weekly forecast, saw us being, very bullish of USD and GBP try. I'm just going to go through, how we did this setup and then move to some setups that I think are shaping up in the market right now. But before we do that, just want to explain the logic behind the type of breakout we're looking for. Now, Bruce Covenor said, in Market Wizards, that trades at breakout after low volatility or from congestion, for which there appears to be no reason for a break, are generally good trades. They are. You think about it. If you're an experienced trader, how often have you just suddenly see a breakout? You can't really see any logic why the breakout is occurring, but it is. It follows through. George Soros also said about these types of breakouts, just trade them, investigate why later on, again saying they're probably going to be high probability trades. Now, to explain this, in Market Wizards he refers to the Heisenberg principle in physics. They don't need to know anything about physics, but what he says is if something is closely observed, the odds are it is going to be altered in the process. Now, in the markets, what this means is that if everyone is looking for a breakout, people are anticipating it, and it's probably not going to happen. Okay, the markets don't accommodate the majority. Last week, again, we saw the British pound. Okay, got above 130, had breaking nearby highs, and everyone in the newswire is saying it's going to 134. Well, it's closely observed. People are anticipating it. It didn't happen. The pound fell back. The general rule is the less observed, the better the trade as well. Now, what does that mean? Well, basically, the less observed the breakout is, by traders, it's probably going to be a good one if it does occur. But also what he said was, when you've got, major markets or the major pairs in Forex, everyone is looking at them. There's a lot of speculative interest, okay, and that makes breakout trading more reliable. So he's saying when it's markets with less speculative interest, then the breakouts are going to be more reliable. Now, I firmly believe that because I've been saying it for the last few weeks. I personally found the majors either frustrating the trade or dull the trade, but in the crosses, some great opportunities, this being one. I just want to show you how we traded it. Now, in terms of, we're obviously huge pound bulls, as regular viewers know, so we're out to buy the pound at any opportunity we can on dips. And what I really liked about this was the pound had bearish news, came down, but it really hammers out support here on these four candles, get a little bit of up move, sideways, sideways, down. Then these two candles, the volatility drops, okay? Now, from our point of view, we think this level is going to hold, but where do we come in? I debated above this candle here, or this one. I thought, actually, wait for the 20-day moving average, okay? 20-day moving average, if there's a universal bearish consensus, which there was against the British pound, that should hold rally. So if we break that on high volatility, the chance of it following through are high. So basically come above those candles there, okay? So we've broken out, got a nice firm close. And there we go, sorry. Diagonal line broken as well. Now, what you normally expect, or we normally expect, is when the 20-day moving average is given way, then basically it should hold a pullback and prices should move away from the 20-day moving average. Now, incidentally, on this big blue candle up, the news wasn't particularly bullish for the British pound at all. Yeah, just bearish sentiment had peaked, I think. But regardless of the reason, we see a nice move up, okay? Now, my normal way of trading, when you get that really low volatility to high, is not to look for the first obvious level to hold, like this one here. Look for the next level up. So that's what we did. So that was the level that, we targeted, which is that 470 level. Now, you think that's a really decent move, 4,500 up to 4,700. Okay, we've come off a bit now. But yeah, these sorts of breakouts are good because when it's come back to test the 20-day moving average and then moves back up, it's probably not coming through. So you can jack up your stop behind here, okay? Initially, you want to put it a little bit further back, obviously, but as soon as the breakouts occurred, get the stop in behind the 20. So, that's obviously a trade we did. It came to fruition nicely. If it hadn't, it still offered good risk to reward. Now let's look at another pair, and this one is shaping up right now, which is another pair that not many speculators trade, which is USD CNH. We're on USD CNH now. What I like about this pair at the moment is obviously, big sharp move down, aggressive move up, aggressive move down, then we drift up to the 20. Now look how small the candles are getting. Touch, touch, there's a touch over here as well. There's another touch, okay? Now, what we want is that 20-day to be taken out and then look for immediate follow through. So probably come in through that candle there, this red one. If I can do it. Okay, so just want to give the 20-day moving average a little bit of room so we can get above it. And for me, the stop protection can be tight. Okay. So basically probably around below these two candles here. Okay. Then we're looking for a break to the upside. Volatility has dropped. We just want to see follow through. And this here is probably the obvious level of resistance, around 686. I always expect it to run on, okay, to the next level up. And I think next level up for me is going to be there, okay? So we'll see what happens with this one. But it's the way we've dropped low volatility, also just around the 20-day moving average, that interests me. Can generate a 3-to-1 risk to reward approximately on this. I can look, when the breakout occurs, it should follow through. If it doesn't follow through, I can, exit the market probably, or hopefully, a small profit or maybe even a small loss. So this one here, I think, looks interesting. Right, let's move to the next pair, which is USD SGD. We are on USD SGD, and in terms of this pair, we can see again volatility is low. You can actually, I've just done it with Bollinger Bands. You can do it with standard deviation channels, or basically just look at the size of the candles. There really hasn't been much going on in this pair recently. After this spike low here, I think we found support. Okay, now look what's happening. 1 touch, 2 touch, 3 touch, 4 touch. We're just coming through the 20-day moving average. Now, for me, on this one, I would just like to see the high taken out. I actually put this in the member center earlier on. You can find it in trading tip section. So we're through the 20, okay? So, sorry, if I could draw a straight line. So, let me just get that in line. Okay, so we're through the 20. We've heard these candles here, okay? Now, on this one, I think just take her above the high. Yeah, she's just drifted off the high. If you want to come in going above the high, here's your first obvious level of resistance. I personally, like I said, when doing these types of breakouts, I don't look for that to hold. I'm trying to target the next level up. So where is the next level up? It's a messy chart. But my personal view, and this is just because I'm bullish of the dollar and just think, yeah, the dollar is at a bearish extreme. I think we could get a pretty explosive move to the upside. So my view is let it go through the high, just put an order in, and then watch if she runs. Stop, I think, can be tucked back behind this low. You go behind 138, say 137.70. But the key is once she goes through the high, she needs to run. Okay, otherwise you can get out, just cover with a small profit or a small loss. Obviously, watch the trade as it progresses. Right, let's move on to the next pair. So what should we have next? We will have another pair that is interesting for us at the moment for a big move. It's USD MXN. We are on the USD MXN. Now, in terms of this one, we've already had, if you saw our last weekly forecast, we've had one go at going through the midband or the 20-day moving average. So what we got here, hammered out support. Volatility is low, okay? And we get above, we decide to hold, moves on nicely, moves on, jack the stop up then. It's a reasonable profit. I did expect it to follow on. It didn't, but we just come out with something, so that's okay. Now what have we done? We've dropped back below the 20, and you can see how tight volatility here is here. We've got like a quadruple bottom here. Now, my own view is you can wait to clear these candles out. I'm not going to do that. I'm going to do that. Okay, so just want it to explode, move above the midband aggressively, or the 20-day moving average. Now this is the first level of resistance here. With volatility tight, I do not expect that to hold. I mean, I'm looking for a higher level, and my own view is we're going to get a really big move. Now obviously I'm being a little bit ambitious with my target here as I put my line up, but I think we could go all the way up here. Okay, now in terms of when we saw the Turkish lira really get hit hard, I think the same is going to happen to the MXN. It is an emerging market currency. The moment you have a universally bearish consensus against the USD, I can't find anyone really bullish on the USD on the MXN at the moment. So what I want to do, come through here, I have the stop initially back behind 1780, and then watch for her to run. Okay, I want to see high volatility, want to see she runs through to the upside, and then once obviously she takes out the 20-day, got a nice blue candle, I'd move my stop behind double trend line support, which is there. So we'll see how this one runs. Now let's look at another pair, which probably even fewer people look at, which is USD PLN. Right, we're on USD PLN, and in terms of this chart, I'm just going to show you a trade that I actually did try, which didn't actually work. But you can see why the risk reward is pretty good on this type of trading. It's here. You got kind of, sorry, my apologies. This candle here coming off a new low, then this one, low volatility, then this one. I thought I'd go for the mid-band break, or the 20-day moving average, and I went for it on that candle there, and then basically covered it for a small loss, and then again tried it on this candle. This candle stopped me out for another small loss, and then of course I've missed it. She's gone, then comes back. But yeah, those two trades were losses, but they're relatively small, so I'm not worried about that, and I got the result pretty quickly, which you want your capital working. Now I'm looking at another one, and it's probably going to be the one that I hope is going to be third time lucky with a nice move to the upside. Now what I like about this chart is, there we go, we've come in to test that blue candle back here again, come down, and then bounced up, go, can't get through. Now these three candles, very, very small. So this gives way, then I'm going to be looking for a big move. Now, I think I said earlier on that, the US dollar, people are extremely bearish of this, and you very often find that, you've got a universal consensus on a currency that's going to keep going down. When it does turn around, just for no reason, really like in that USD try trade we looked at earlier on. So where could we come in? Well, you've obviously got the mid-band straight, 20-day moving average. Sorry, just at 375. You've got the test there. You've got a little poke through. I'm just basically going to come in above 375. I'm not really bothered about that tail, if I'm honest. We're sort of firming up. Obviously, still very low volatility. So again, a break. This will not hold, in my view, because the consensus on the USD is so bearish. It's not going to take much to ignite a big move to the upside. So I'm going to go for, literally up to these two candles here. This one here. I think we should see, a really decent move. But again, what we'll do is when she comes through, we'll see how she follows through. And I'm hoping on this one is going to give, a really a decent move to the upside. But like I said, 2 losses on this one. This, third one, if it follows through, we'll cover those and a lot more. I really do like this, form of trading. Your capital is just not tied up. You get your result quickly. Either a nice profit, or you get a small loss or a minor profit. So personally, just trading low volatility breakouts using a 20-day move-in average, I always think is a good way to trade. Welcome back after that short review there of a few chart setups. They're all the ones we're looking at going forward are all against the USD, but there's plenty more in other currency pairs. If you look around, just scan all the pairs. Now, in terms of the USD, we do generally have a very bearish view towards it. I just have a feeling it'll just turn around. And like what happens in many markets, okay, the turnaround comes with no really big news or anything like that. That happens in all markets. And that's just telling you the bearish consensus has peaked, and hopefully good moves. Now, in terms of, as you can see from that style of trading, risk reward is good. You can normally get out with a small loss, if you're coming out the market on stop, or even a small profit. But when you get a nice move to the upside, and many of those trades develop into nice up moves like GBP try, it's great. It's a great move, okay? And I've said it before, majors recently have been pretty boring. Near enough all our profits here have been made in more minor pairs, which most traders don't bother to look at. And I've never really been one for trading, just the majors. All markets should be scanned, or as many as possible, to increase your opportunities for profit. And trading minor pairs, sure, you pay a little bit more on the pip spread, but you just got to look at that in relation to the profit potential you can make against your risk. Okay, you pay a few more pips in GBP try, but look at the profit that one made. Okay, a few pips doesn't matter. It only really matters, in my view, to people who trade really short term, day trading and scalping. And for me, that's just a way to lose money. Now, this method of trading also makes your capital work hard. A lot of traders go into trades and just sit on them for months when they're doing nothing. With this style of trading, you get a result quickly. So your money is working hard, your risk reward is good. I think it's a great way to trade. I would encourage anyone to look for low volatility to high when they're trading breakouts. So that is the video for today. I hope you enjoyed it. Take care. Have a good day.